Hello, everybody. Welcome back to Every Day is Saturday. I'm Matt Stahl, along with my partner, Brad Gatto.
Hello, sir.
Whoa, that was a good one. Never know what I'm going to get. Today, we are going to be digging into a Vanguard study that's called Advisor Alpha. And it's a really interesting study talking about the value that a financial advisor can provide to clients. We will get into that shortly. Before we do that, Brad, what's new?
It is going to be interesting. It sounds kind of boring.
It's not.
Right.
Well,
that's what I just don't want people to be like, oh, I'm not listening to this.
Stay tuned.
And then, yeah, exactly.
Stay tuned.
Just stick with us. It's going to be interesting because there's some irony.
There is, and we'll get to that.
But there's also some interesting detail. Most of the value is not going to be from what you think it is. That'll be my tease.
There you go. Nice. A little cliffhanger.
What did you ask me?
I said, what's new?
Oh. The same question you ask me every episode, and I didn't know what you asked. I've done a lot of travel already in 2024. I'm in a couple week break without having to get on an airplane, which is the longest break I've had yet this year. So enjoying being at home, frankly, and getting into a little bit better of a routine.
Love it.
With food and sleep and all the things. It's not travel's fault. It's my fault. But when I travel, I just,
You're like everybody else.
Whatever I eat is kind of what happens. So anyway, that's what's new with me, man. I'm just home right now, which is great until the first week of March. I guess next week. Never mind. Shoot.
Dang it.
As we record this, what is today? The 26th of February. So yeah, I got a couple days. That's ridiculous. I don't know what I thought it was. Cool update by me. How about you?
I'm in the same spot as you. So I was about to say I'm the opposite, but it sounds like we're in the same spot. So
boy.
I will not be home for the next handful of weeks. All fun stuff, but
handful of weeks.
Well, parts of the weeks.
Okay. But you got a lot of travel in the coming weeks, like every week in a row kind of situation.
Next 2 weeks. The week after that is for fun, but it is still being away from home, out of the routine, and all good stuff. But I am looking forward to being home for the month of April.
The month of April?
Yes.
I actually just went through on Friday with Ashley, kind of I was basically like, hey, we have to go through my calendar. And there's so many things that I know that are coming up that are not in there and all this stuff. And there's all these family things and you need to help me manage my calendar better. I was telling my wife this. One of the things that I was like, we have to get in there is time with my wife. Because she always gets the last fruits of whatever's available or left over in my calendar, which recently has been zero. So I haven't been able to hang out with my wife in any meaningful way for a while, but that's going to change.
Awesome.
In the last episode, you made a prognostication that you were going to change something in your life. So there's stick it to me if I'm wrong that I don't date my wife.
That is recorded.
All right, let's jump into this Vanguard study.
Let's do it.
Why don't you lead the way?
Yeah, so it's called the Vanguard Advisors Alpha. And the first time this came out was way back in 2001.
Alpha is a fancy word for value.
Yeah, additional value. So essentially it's what, if any, value is created by working with an advisor versus someone doing it on their own. And the first time this came out was 2001. A lot has changed since then. And the really ironic thing that we kind of left as a cliffhanger here is Vanguard as a whole tends to be the place you think of for a DIY investor that's not working with an advisor.
Yeah.
Very low cost index funds. And so it's very ironic that they come out with this study.
Yeah. I love the irony. So 2001 was the first time that they did this. Like Matt said, a very different time. I was in my head, I was laughing because all I could think of was there's a comedian that one of his jokes is I feel like he just says it. He's like, I was born in the 1900s. I feel like I just need to say that. one of my friends who's younger than me, he's in his 30s, and his kid, who is I think 8, was railing on him because he said something, and he's basically making fun of his dad because he was old. He's like, you were born in the 1900s. So they did the study for the first time a while back, 2001, and they've since updated the study. So interesting enough that Vanguard was the one that commissioned the study in the first place, given the fact that they're kind of the bastion for DIY investors. Right. Like you said, double interesting that they chose to go back and do it again.
Yeah, for sure. And their theory is that today there's actually an opportunity to provide even more value as an advisor than there was back in 2001.
Well, that's really interesting. We'll have to dig into that and figure out why, because now I have no idea. So let me be very, very clear. This is me just having a little fun with conversation. I wonder if they redid it hoping it was going to go the other way.
Possibly. I don't know. Were there computers in 2001?
Green screens, man. I'm trying to, now that you say that, I'm trying to remember in 2001, obviously we had computers, but like what functionality and what did they look like? I'm trying to.
You had to go to the lab and rent one.
Yeah. Remember when Apple came out with I remember my high school got a couple and they were like super expensive and
Apple
they
IIe.
were like, no, they were like green backed and blue backed. There was like a regular desktop computer, but they had like funky colors.
Yeah. That was the Mac. That was their first. I think that was the first Mac.
Those were super expensive.
Yes. And they look so cool. I did not have access to those in the engineering lab. All right, back on track. The overall theoretical value that they spell out is about 3% per year.
Now that's a lot.
That is a lot. And
up to 3%.
Up to 3%.
Is that right?
That is right. And they point out that actually...
Or even exceed. Actually, their language is
that, yes.
up to or even exceeding 3%.
Yes. I mean, in some cases, it's probably zero, but... up to
or negative
3% or negative. So
it could absolutely be negative. But let's just put that into perspective because that matters a ton, right? 3% is a lot.
Especially considering what you just pointed out in our last podcast of what you assume a rate of return is
for.
Right? So.
Yeah. I didn't prepare a bunch of math for, to make this super detailed and nerdy, but like over time, adding 1% of value to a portfolio, no matter how do you get that done, whether that's beating the markets, beating the benchmark, or decreasing fees, or decreasing tax liability, or something like that, is a lot. And so extremely surprising to both of us that Vanguard came up with up to, if maybe not even exceeding 3%. Now, they broke it down into a lot of different categories of where value could be added.
Yeah. So before we go into those categories, just a couple of things I want to point out. Number one, they do point out that this is subjective. This is not easy to quantify, right?
Yep.
And so this is not something that shows up on a statement. And really,
wouldn't that be nice if
really,
if it did?
Here we go. Now we're talking. So it's not something you see show up on a statement. And in addition to that, oftentimes that's the first spot that people's mind goes is the value an advisor provides is excess return.
Yeah.
I'm going to get it more return over here versus if I just invested on my own. And so they're quick to point out that that is not one of the categories.
So the primary reason people probably think about advisors or what they think of when they think of an advisor is if I could get 7% on my own and the advisor can't do something more than 7%, then they're not worth hiring. And Vanguard's point of this white paper, which is 32 pages long, is that's not even part of it.
Right. We'll go through the categories shortly, but big picture, so much of this comes down to our emotional behavior and balancing fear and greed and some of the value that is provided in helping folks to navigate that. So
we don't ever talk about that kind of stuff on this podcast.
Never. Zero. And one thing I do, before we go through the categories, one thing I do want to point out, and it is in the paper, what's not included in any of these categories are actually some of the tangible things that we see Fiat helping with clients. So charitable giving strategies, estate planning, tax loss harvesting, business continuation. So these are real things that are they're not in any of these categories. So without further ado, let's jump into what all these different categories are. Okay. All right. So let's go through the 7 categories and then we'll go back through and give what the
percentages
value ranges are. Make sense? So first off, we have suitable asset allocation. Number 2, cost-effective implementation. Number 3,
in other words, like the expenses.
Yeah, we'll explain
associated
this.
with okay.
Some of this sounds like jargon, but
a lot of jargon.
Number 3 is rebalancing. Next, behavioral coaching, asset location, and spending strategy or withdrawal order. All right, so let's start with suitable asset allocation. And they've actually applied a number of 0 with an asterisk on this one. So this is not even weighted. So there could be a number there, but they didn't actually give a range. And so suitable asset allocation, what we mean by this is broadly diversified, among many different asset classes. And we could go super deep into this, but think of, we have stocks and we have bonds and we have different overall asset classes. Then you have different sizes of stocks within there.
Yep.
And how those companies grow or they're stable. So there's so many different layers, but asset allocation is basically just based on that person's risk tolerance and their goals. Are they diversified appropriately across all those asset classes?
Yep. Which again, I think is kind of the broad expectation of a prospect walking into an advisor's offices. This is where they're going to provide value. And it is worth noting, of these 7 categories, it is a category, but again, to Matt's point, Vanguard gave no value to this. So when you look at 3% as like 3.00, anything after the 0, my industry calls basis points. So 0.1 would be 10 basis points. As an example, they give 0 basis points. There's no value added. So of the 300 basis points kind of allotted of where we could come up with 3% value, this is at a 0.
At 0.
It's not to say, and Vanguard's point is not to say that they can't do it and that it's not possible that that's true, that you walk into an advisor's office and that their overall diversification or allocation for you adds value. We're just not going to give any weight to that.
We're not going to assign a value. And I would say there's definitely scenarios where that is a number. If you have someone that's been really successful and has saved up a pile of money, but they have 0 interest in investing or the financial world, like they're not going to have much to base that on.
Yeah.
And so there definitely is possibly value there, but it's
absolutely. Especially people coming out of like 401ks where you're not allowed to do your own investing and you have like a menu of 10 to 15 options. And a lot of times those aren't great options, or it doesn't even allow you to do broad diversification because they're fairly limited. Now, there's been recent legislation that have kind of pushed 401k plans into like meeting standards and having certain asset classes represented inside of the plan. But even then, I find it falls short a lot of times. And so it is possible.
Yeah.
But we're going to give no weight to that, as Vanguard gave no weight to it in our conversation.
All right. Next up, we have cost-effective implementation. And so
what in the world does that mean?
What does that mean? The number assigned to that is possibly 30 basis points or
0.3%.
And cost-effective implementation, what is meant by this is if we have an investment policy statement and we have an asset allocation plan and we decide we're going to go out and select what those investments are, it is choosing the most efficient of those particular options.
Yep.
And so a perfect example of this is retail versus institutional funds would be one example, where if I'm a retail investor, I'm going out and investing on my own, I may not have access to an institutional fund that could be lower in cost.
Same fund, less cost. Costco pricing versus retail pricing. That's kind of what you're saying.
Yeah. And that's just that's on the surface. And as you dig into different investment options, whether it's an exchange traded fund or a mutual fund, there's actually many layers of expenses possible in there. Mm-hmm. So in many cases, the value an advisor might provide is to actually just dig into that in further detail to understand all the expenses that are there.
To be fair, I'm going to play devil's advocate.
Yep.
The opposite can also be true.
Right. Yeah, for sure.
I've seen a lot of people walk through our doors that have advisors where their portfolios are so expensive,
right,
relative to what they could be. And so it's almost like the advisors, trying to increase their fees. Now, I'm not saying that they're doing that, and I'm not going to judge the other advisor in that way, but I've just seen it work out the other way where it doesn't even add value. It actually takes away value. And so if you're listening to this as a person that's looking to hire an advisor or of a current client of Fiat, this is one of the reasons we are so transparent about fees and expenses, because we know this is an area where I can actually quantify some value.
Yep.
Hard to quantify any value anywhere. That said, this is one of those areas where I can point at a piece of paper and go, hey, look, this one costs this. This is the same thing and it costs less.
Right.
Or it's just, whatever. And so the analogy I like to use there is when you're building your home, there's certain materials you're going to pick out to build your home where you go, you know what, I just need the baseline. I don't need anything fancy. I just need it to do its job, right? I don't need the prettiest studs in my walls. I just need them to work and be functional. then there's other areas where you're going to choose to buy the most expensive stuff because you value that and you perceive, at least anyway, that the more expensive version of that is going to provide more value, whether it's going to last longer, it's not going to break, or whatever it may be, right? So investing is the same way. So just as an investor, DIYer, have an advisor in your life or otherwise, just know fees and expenses. Just be aware of it because there's value that can be provided there.
Yeah. So the number signed here is 30 basis points. In some cases, it could be negative 200 basis points in the wrong way.
Yikes.
All right. Third is rebalancing,
which is just exactly what it sounds like.
Yes.
Getting back to your true north, or Matt used a big term earlier. You said investment policy statement, or IPS.
Yep.
Like if you actually have kind of a statement of what you're trying to get done, or at least a goal or a plan of what you're setting out to do, and so then you set that all in place. That's like, in the analogy I'll use there is like, we have figured out the highway that you should be driving on. And we're going to put you on that highway. We're going to head in the direction that we want to head. But that doesn't mean you can take your hands off the steering wheel. Now we need to have these micro adjustments as we're driving down the road. As we all know and understand, you're envisioning yourself driving down the road right now, and it's a straight road. But there's still these tiny little adjustments you need to make to stay in your lane and to stay on the road. That's rebalancing.
Right. And I think an important point to add to this is, well, the value diversification is because some asset classes are going to do well where others don't. And ideally, there's some non-correlation there. And the big piece of this that's pointed out is not only the rebalancing itself, but actually following through on that.
Yeah.
And the example of this is the plan may make sense and rebalancing makes sense until we hit an anomaly where we have a unique situation in a market of some sort, and suddenly we want to abandon the plan. And our emotions get in the way of it. We say, well, this time we're just going to wait on it. And so the example of that is behavioral in just sticking to the plan.
Yep.
So we may be selling something that's doing really well, an asset class is doing really well, to buy something that's not.
So the value could be created just through the fact that rebalancing is happening when it wasn't in the past, or forcing a rebalance in a situation where the client might not want to on their own.
Right. Yes.
And the amount of value they assigned to that was 14 basis points, or 0.14%.
That's a very specific number.
It is a very specific number. Now, again, I can't stress enough about how over time, every basis point matters. Every basis point matters, because whatever value is added or fee is saved, vice versa, is more money in the account that then gets to grow to be more money later. And so although 0.14 doesn't sound like a lot, it can add up.
Over time, especially. Let's next go to asset location. And the range for asset location is 0 to 60 basis points.
So that's a bigger one.
0 to 0.6. And asset location, so what is meant by that?
The location of the asset.
so asset location, easy way to think about this is we talk a lot about tax diversification here. So asset location.
That's guaranteed that's the answer my kids would have gave me. It's where you hold it.
Yes.
From a tax perspective, we talk about this a ton at Fiat. There's only 3 tax buckets: pre, post, and free. I like to call them. That's normal people language: pre-tax money, post-tax money, tax-free money.
Yep.
Sometimes it's not about the actual asset allocation, which is the investment side of it, but it's the location of where you hold it and the tax impact of that. This is something we do a ton at Fiat, because at the end of the day, there's so many things we can't control. Well, one of the things I can control is where you put money from a tax perspective and how that's going to affect not only your 1040 this year, but then into the future. And so I would argue, of course I'm biased, that they assigned 0 to 60 basis points to this. We're for sure at Fiat on the top end of that.
Yeah.
If not even beyond their averages that they put out here, just simply because it is a huge piece of conversation or a large focus for us. It's not about so much what you own, but where you own it sometimes.
Yeah. I think that's a really good point. I think in addition to that is also paying attention to what is the actual type of investment held within those different accounts, possibly too.
How much risk are you taking in each tax bucket?
Right.
Yep. Absolutely.
All right. Next up, we have spending strategy or withdraw order. And the range there is 0 to 120 basis points. So 0 to 1.2% per year. And again, to reiterate, I think that Fiat as a whole, just based on the process and the folks that we're working with, would probably tend to be higher on that higher end, just based on the emphasis on the spending strategy.
It's one of the areas we focus on. Again, just very simply put, very focused on what dollar to spend when it comes to that strategy. Now, for some people, that isn't even a possibility of value added from an advisor because they are not in the phase of life where withdrawing money or spending strategy is a part of their plan. They're just in saving mode and all the money is just kind of getting put away. The analogy we use all the time is climbing a mountain versus descending a mountain. They're in mountain climbing mode and they have not yet ascended the mountain to the point where they get to that withdrawal need. But for us, Vanguard is driving the point home that we try to make all the time, which is it absolutely matters what dollar you spend just as much as how many dollars you spend.
Right.
And so it ties directly, in my opinion, into that asset location category. And if you notice, in both of those, there's a huge range, 0 to 60 and 0 to 120. Right. So you combine the tax impact and which dollar out of there you pull out. Vanguard's saying in totality, there's either anywhere between 0 value added and 180 basis points, those two combined, or 1.8%. This is why we focus on it.
That's nearly half of the annual return.
That's nearly half the annual return.
Yeah. Next up is
not that we they need to go back and listen to the previous episode. I'm not saying that at Fiat, if you come work with us, you're only going to make 4%. That is not what we're saying. In our margin of safety or room for error, our default setting for retirement is a 4% expectation of growth.
From a plan.
We hope to get a lot more than that.
Yes. Good point.
Making it sound like, well, they only make 4% there. It's less than cash right now. It's pretty good. You could take your money out of your money market, give it to Fiat, and make less money.
Next up is total return versus income investing. What is meant by this is in the past, oftentimes there was the assumption that as I transition into retirement, all the money that I would spend is only income. So it's only yield from a bond or it's dividend from a dividend paying stock. And this was in 2022. So, this is
interest rates have changed a little bit since this came out.
Things change. But the statement they made in here is this is not the world we live in any longer where interest rates are at a point where, but that's just further evidence that those things change so much over time.
Yeah.
Where what it points out is if you have that set in your mind, it could be thought of as a limiting belief because you believe that's the only money that can be spent, which could then in turn lead to not being diversified appropriately from an asset allocation standpoint. Yep. So if I'm just chasing dividends, that means I'm only investing in one kind of stock.
Yep.
If I'm just chasing yield, I may only invest in high yield bonds, which can put me at risk from the value standpoint based on where the market is at that point in time.
Yeah.
So,
but how much value did they assign to that?
That is also a 0 with an asterisk. So it's possibly more than that, but they did assign 0.
Yeah. So. They didn't give any weight to that. So let's go to the last one.
Drum roll.
Brrr. We saved this one for last because we're biased.
Yeah, for sure. which is that's kind of a nice joke.
Yeah, I'm adding irony to the already ironic podcast episode. One more level of irony, and we're going to turn into Seinfeld.
That's right. Was that ironic? No. All right. Finally, is behavioral
Ask
coaching.
Alanis Morissette, she'll know.
Oh, wow. Finally.
Back to 2001.
That's right.
See what I did there?
There we are. Behavioral coaching. And this is a big, big one. 0 to possibly over 200 basis points. So 0 to nearly over possibly over 2%.
Nearly over
or over 2% per year. I hope if you've been listening to this podcast or tuned in to any workshops, you are aware that behavioral coaching is something or behavioral finance in general is something that's really important here. Recognizing the fact that one decision made, one emotional decision made could change the course of our plan over time. And what is pointed out in here is the behavioral coaching side of things. This isn't necessarily something where you see it year in and year out. In a lot of cases, like I said before, one of those decisions could make up, 200 basis points just in one moment from not making a decision based on fear or greed and upending the rest of the plan.
To me, it turns the whole conversation of why you would ever hire an advisor completely on its head. Mm-hmm. Because if you looked at this and you took off the categories, the names of the categories, so that the average, person that's looking to hire an advisor didn't know where the value is coming from, and said, okay, you can get 0% from this, 0.3 from this, 0.14 here, 0 to 2% here, 0 to 0.6 here, that kind of stuff, and said, which one, if you could hire an advisor that was really good at any of these things, which one would you pick? Well, without understanding what they were picking, if they didn't know, of course they're going to pick the one that has the potential to provide the most value.
Yeah.
And then if you look at it, that is not why people tend to hire financial advisors. They don't normally go to an advisor for the same reason they go to a therapist, which is, hey, save me from myself, would you?
Right.
I need to kind of work through my thoughts. I need somebody to kind of like speak into my life and kind of give me some feedback and help me think through some of these things and make sure I don't make detrimental decisions. When in reality, what Vanguard is saying here, and they're doubling down on, is, look, this is the number one reason to hire an advisor. Now, funny enough, you and I have, prior to even knowing what we were talking about, or even giving it the term, behavioral finance or behavioral coaching, 15 years ago, we were laughing about how we should take the chairs out of our office that our clients sit in and replace them with like a Chase lounge,
right?
That we would think of that you would sit in when you go talk to a therapist,
right? Yeah.
Right? Because back then we realized that we had this need, I guess, to help our clients emotionally as much as we did logically.
Yeah. Well, it's also it is one of the areas that can be so emotional. And at the same time, those emotions can definitely not serve us.
Matt, have you ever had a situation in life where your emotions didn't serve you well?
There's definitely a possibility.
Oh, that's a podcast series right there.
Right.
So all that to say, we will put the link to the white paper if you guys want it in our show notes, because we didn't write it. We're just reading you what the study that Vanguard did and kind of how they broke this down. It is like 32 pages long. So of course we kind of truncated a big part of the conversation, but just went through these key areas as they talked about it. And it's entirely possible, and I'm going to admit this on the show, that this is confirmation bias for me. Because when I look at this study, which I know it came out in 2022, but honestly, the first time I saw it was a handful of weeks ago, I was like, shaking my fist like in like celebration of like, yes, this is exactly what we're doing. We're focusing on the three things at Fiat in our planning that Vanguard says provides the most value. Mm-hmm. And so it almost feels like I wrote it to prove my own point, which would be a confirmation bias type thing. But it just makes me, I want to double down on the things that we're doing. Where you hold your money, how you choose to withdraw your money, and making sure you've got somebody that speaks into your life objectively is all very important. Now, there's some other areas there that you can focus in on and find other value as well. But at the end of the day, I would argue, and Vanguard would tell you, just based solely on numbers, those are the areas where you get the most value out of a relationship. And so if you're looking to hire a financial advisor, my recommendation to you would be to ask questions around that. What sort of planning are you doing around asset location? In other words, kind of tax planning in where I'm going to hold my money. What type of planning or philosophies do you have on how to spend my money? Do you have any sort of philosophies designed there? And then last but not least, I think part of it is the fiduciary piece of it. If you were to like Google search, what questions should I ask a financial advisor? Like if I'm searching, like when I go into their office, the top two questions, and some of this is, marketing, but it is what it is, are they a CFP and are they a fiduciary? Right. I'm not saying those are the right questions. I'm just saying that's what you're going to find on Google. And fiduciary has become a really big buzzword. And fiduciary is a fancy word for we are legally obligated or bound to do what is in the client's best interest, which is wonderful. But you add in behavioral coaching to that, and I would say that's half of the definition. The full definition is you have to do what's in your client's best interest that your client will allow you to do. Right. Your client has to be able to sleep at night. Yep. And they need to be able to stay in the game, as we talked about in the last podcast episode. And that's a really important part of what we do here. And I would argue it's the hardest part of what we do.
Absolutely. Yeah. Anytime emotions are involved, it's going to be complex.
Well said. With that said, like I mentioned before, we will put the link to the white paper in the show notes if you want to read it for yourselves. As always, thanks for joining us for this episode of Every Day is Saturday. If you need any more information on what we've got going on here at Fiat, or you want to reach out to us, or you need to hire an advisor, feel free to reach out. The website has all the information you're going to need. It's fiatwm.com, fiatwm.com. I'm Brad Gatto, here with my co-host, Matt Stahl. Thanks for joining us, and we will see all of you next Saturday.
Thank you for listening to Every Day is Saturday. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Fiat Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.